that. Are we live?
And
I
we
think
are
we're live.
live. We're live.
All right. We are live. And let's make sure YouTube is actually working. Yep, looks good. Beautiful. Okay, welcome everybody. It is January 28th, 2025, and this is the Trillion Dollar Show, where our mission is to save $1 trillion for the American taxpayer. And before we get into all the questions and stuff, there is a couple things I want to talk about regarding that $1 trillion. And we'll get into some things that could work, some things that probably won't work. All right, but who am I? Who are we? What are we doing? All that stuff. So let's just jump in here. So this is the $1 trillion Show. I'm your host, Neal, founder of Tax Sherpa. Serena's here with us, and she
Hi.
is our everything person. That's all I like to say. I guess technically your title is ops manager, right?
Yep,
Uh,
that's true.
but you take care of all the stuff that that I don't want to. So the mission is to save $1 trillion in taxes. And how we're going to do that is we're going to scale tax saving strategies through technology. So, obviously we have our own clients. There is definitely a limit on how many clients we can serve in a quality kind of way. And that limit is not going to get us to $1 trillion. So how do we get there? We get there by broadening the insight into tax strategy through technology, through streams like this, educational materials, courses, all this kind of stuff. So when people can do their own tax strategy, even if it's a little bit. So Serena and I were just talking about a client she just got off call with, and they're a retired couple, and I made the point that if they did a qualified charitable distribution, then it would last year it would have saved them $400 in taxes. So that's the kind of thing that, if more people understood, then, hundreds of thousands of retirees could save, a few hundred, maybe 1,000, maybe $2,000 a year on their taxes. And, you know, giant amounts of money there to be saved just in taxes, just in that one strategy. And most people just aren't aware of it. And, and like the relevant people involved are not making them aware of it and not communicating these possibilities. So that's how we're going to get to our $1 trillion is by scaling through these technological tools that we have now. All right. And for me, I got into the whole tax game because the IRS said I owed them $1.3 million. And I said, no, I don't. And that was a 3-year battle, but I eventually won, more or less, and been helping people ever since. So the starter course is a great place to start. It's sort of like the intro to DIY tax planning, and we'll get into how you can get that later on. But it's a good overview and starter. It's the starter course. That's why it's called that. And then we get into the questions. So the answer to every tax question, I already have the answer. The answer is it depends. And it
Depends.
depends on what we call facts and circumstances. Because what is true for you is not necessarily true for somebody else. Um, there's lots of nuances, lots of circumstantial things that happen in the tax world. And so it really does depend on what is true for you and your individual situation. So before we get into the questions, I did want to talk a little bit about this idea that's going around, and Trump was talking at some convention or something or other, saying, "Hey, we're going to get rid of the income tax, and then we're only going to have tariffs." And I hate to be the bearer of bad news, not going to work. So I'm trying to think of the fastest way to demonstrate this. St. Louis, Fred. So this is the Federal Reserve Economic Data database, and it's a great tool if you want to look up government information. And let's see, federal receipts, current government receipts, and let's make this annual, billions of dollars, annual. I think some, no, end of period. Okay. Close enough. So this is only back in 23. The 2024 number is actually 4.3 trillion. So anyway, 3 to 4 trillion dollars worth of federal government tax receipts. And that's all the different kinds of taxes, individual income tax, corporate income tax, social security tax, estate tax, just any kind of tax. And so this particular series is a little bit behind, but let's just round it off $4 trillion. And then we can say, well, okay, if we were to replace the income tax or if we were to replace the IRS, because the IRS administers all this stuff, if we were to get rid of that and just to have tariffs, what are we talking about? Well, we would need to raise similar amounts of money for the government. It doesn't have to be exactly the same, but similar, because the government spending is enormous. It's $6 trillion. And so if right now the tariffs raise about $80 billion, and so there's about $4 trillion worth of imports a year. So if we have 4 trillion of imports that could be tariffed, and we have to raise $4 trillion in tariffs, that would imply a 100% tariff on all imported goods. And as soon as you do that, if the cost of all imports doubles, people are going to buy less. So that means the amount of tariff that you're going to get is going to be on a smaller number than before. So maybe you need a 150% tariff. Maybe you need a 200% tariff on everything in order to raise the same amount of revenue for the federal government. And that's just not going to work, basically. So math-wise, it just doesn't add up. And if you replace it and you don't raise a similar kind of amount of money, then the remainder is going to be financed by deficit spending, like it has been, but more, right? Instead of $1.6 trillion deficits, we'll have $3 trillion deficits, $4 trillion deficits, and so that will just cause rampant inflation. And as we've seen over the last couple of years, 10% inflation is like the most Americans are willing to tolerate. And they become very, very unhappy with that. So it's basically just a non-starter math-wise. On top of that, there's an additional issue where let's say Trump gets, is able to implement this against all my mathematical arguments. So no more IRS, and now we're just doing tariffs. You have to think there's still an amendment to the Constitution, the 16th Amendment, that allows for the income tax. And so if you want to be real about this, you would have to repeal that amendment. And that's obviously a much more difficult process. There's more constitutional hurdles for doing that, because if you don't, then somewhere down the, maybe not this administration, maybe not the next one, but 20 years down the road, if there's tariffs and they still have the power to create an income tax, then you're going to end up with both at some point, and that would be not good. So, in order to constrain the government spending or to constrain the government taxation system, you would have to pick one or the other, and enforce that constitutionally, which also I don't see happening. So that is my cold water on that whole meme. And yeah, sorry to burst everybody's bubble, but for the foreseeable future, the tax system that we have is what we're going to have. So, all right. Now, with all that said, let's talk about the actual questions. Let me turn off share here so we can see our beautiful faces. All right. So what do we have teed up here, Serena?
So we do have a investment, retirement, and home ownership question.
Okay.
A client wants to know what's a 1031 exchange and how does it help real estate investors?
Okay. So a 1031 exchange is a tax-free like-kind exchange. So in the old days, before 2017, this could potentially apply to various kinds of business assets. In 2017, the law was changed and says only real estate qualifies. So if you have investment property, investment real estate, you can do a like-kind exchange, meaning that you sell one piece of investment property, you take that money and you reinvest it into other investment property, investment real estate. And it doesn't have to be 1-for-1. It could be 1-to-2, 1-to-3, 3-to-2, any kind of arrangement. As long as the money flow is taken care of, then it is tax-free because you didn't actually bring that money home for personal use. You kept it working in the economy. So it's an incentive to keep your real estate investment working for providing housing and commercial real estate and whatever else. Um, so that's what it is. It does not apply to personal residences at all. So it has to be investment property. And you can't just decide to do it on your own. You have to use what's called a 1031 intermediary. And basically, they hold the funds from the sale. And then you have a certain timeline, it's like 3 months, to identify the next property you want to roll that money into. And then you have another 3 months to close on the property. So basically, there's a 6 month window. Um, and sometimes you can do reverse, sometimes you can do pre-identification. So there's different ways to massage that. But your 1031 intermediary will handle all that and can guide you along the way. So here's the thing about 1031 exchanges. Well, two things. One is that they don't have to be complete. So let's say I've got $500,000 of investment real estate. I want to 1031 that, but I want to take 100 off the top for myself. You can do that, and you can roll the rest of it. So the 400 would roll tax free or tax deferred technically, but the 100 you bring home would be taxed. So you can split it up that way as you like. The other thing about 1031 exchanges is that your basis carries forward. What that means is, let's say I've got this $500,000 property that I bought for 200,000 however long ago, and that's my cost basis. So I've got $300,000 worth of gain. I don't want to pay tax on the 300. I want to roll it all into 1031 and buy something else bigger and better and all that kind of stuff. So when I do that, my cost basis for that second property is still the 200 from the first property. And so assuming things go well, your cost basis becomes a smaller and smaller fraction, and your potential capital gain gets bigger and bigger and bigger over time. So that works just fine, so long as you don't sell that property you exchanged into. So what ends up happening is that some people get stuck because they get overly aggressive on their financing. So we saw this a lot in 2008 and that 2008 to 2012 real estate crash. Commercial, we might be seeing that now because people are getting their rates reset because a lot of commercial loans have 5-year balloons and things like that. So the so what ends up happening is, like, let's say I bought that place for 200, sold it for 500, rolled that 500 into something that was worth, I don't know, 2 million, and 500,000 was a down payment, right? So at that point, it's like, well, now I've got a $2 billion property, but I only have $500,000 of equity in it. And if that equity decreases because we have a market correction of 20%, 25%, whatever, I might be underwater from a financing perspective and not get any cash at all if I were to sell that property. And still, I would have a tax bill of, even if I sold it at 1.5, I would still have a tax bill on $1.3 million worth of gains. So, in those kind of scenarios, if people get caught on leverage, then it can be real nasty. So, the where 1031s work beautifully is in the buy, borrow, die strategy. You buy, you borrow, and to pull out some equity for cash flow, which is not a taxable event because it's a loan. And you keep doing that, keep doing that, keep doing that, and then you die because your heirs get a step up in basis and they don't have to pay tax on the gain, and you are deceased. So you no longer need to worry about taxes. Because the two things that are certain in life, right? Death and taxes. And you'll be done with the tax part.
Horrible.
So, so yeah, I mean, 1031s are super powerful. People use them all the time. It's just you got to be careful with the long-term planning. That's all. As long as that fits with your estate plan and your overall life investment approach, then great, go for it.
Alrighty. That was kind of sad news.
Well, it's just we are all mortal in this world, so it is what it is.
Right, understood, understood. So we do have investment and retirement question.
Yeah.
Someone wants to know what's the difference between short-term and long-term capital gains?
So short-term capital gains is capital. Oh, so capital gain is a gain or loss on a capital asset. So a capital asset is something that does not get consumed within a year. So, like if you buy a computer, for example, typically those will be depreciated over 5 years. Cars, typically 5 years. Rental real estate for residentials, 27 and a half years, and all those kind of things. Um, as opposed to like paper you buy and you consume it, so it becomes an expense and it's not capital. Um, so I just got a shipment of paper in the office here today. But um, a capital gain or capital loss is a gain or loss on a capital asset. And so whether it's long term or short term depends on if you held that asset for less than a year, short term, greater than a year is long term. So if you have short-term capital gains, then those get taxed at whatever your ordinary rate is. So let's say you're in the 24% bracket, your short-term capital gains rate is going to be 24%. If you're in the 35% bracket, your capital gains rate, short-term capital gains rate is going to be 35%. Long-term capital gains are advantaged in the tax code because you pay a lower rate than your ordinary rate. So it's either going to be zero. Just talking federal here. It's either going to be 0%, 15%, or 20%. There might be an extra kicker depending on your overall income of 3.8%. That's one of the Obamacare taxes, the net investment income tax. Um, so basically, it can be anywhere from 0% up to 23.8% federally for long-term capital gains tax. Now, however you cut it, it ends up being about half of your ordinary rate. Because I mean, the brackets are offset, so that's not exact, but just ballpark kind of figures. Um, so long-term capital gains sounds like a good idea, and sometimes it is, but sometimes it isn't. So here's the thing about long-term capital gains. This is the only place in the tax code where you are paying current dollars on old inflated away dollars. So let's say you bought something for $1,000 in 1980, right? So we've got like retired people who have held stock forever, right? Um, so in fact, let me show this. Let me bring up. If you go to the BLS, which is the Bureau of Labor Statistics, they have what an inflation calculator. Here you go. bls.gov/data/inflation_calculator.htm. So this guy right here. So let's say you bought something for $1,000 in 1980, okay? And then you sold it for $10,000 in 2025. 1980. Or let's say December 2024. Okay. So $1,000 45 years ago has the same buying power as $4,000 today, but you would pay long-term capital gains on $9,000 worth of gain. But inflation adjusted, you only had $6,000. So you're paying tax on a $3,000 worth of inflation that was eroded away from your purchasing power. Now, it's hard to track this because we have, real terms versus nominal terms as far as inflation adjustments and all that kind of stuff. So 1,000 to 10,000 sounds like a home run, but really in purchasing power, it was 4,000 to 10,000. So instead of a 10x, it's actually 2.5x, but you're paying tax on the 10x. So, there can be cases depending on the numbers and the years involved. There can be cases where on real terms you actually have a loss, but you're still paying taxes on it, so you end up with an infinite tax rate. So it's something to be. This is an issue that I have become more and more upset with over like the last year, and you just have to be really mindful of what's going on with the purchasing power of the dollar that you have invested. So your investment needs to outpace inflation. And obviously inflation changes. Some years it's 2%, some years it's 10%, long-term historical average, 6.5%. So if you're not beating 6.5%, then it's unlikely that you're actually coming out ahead. So that's just something to be aware of, and you want to be investing with that in mind. So if you end up having to pay tax on something where you made less than 6.5% annually, you're probably having an infinite tax rate, which is not great.
Alrighty, understood. Now we have a funny question here.
Okay.
Someone asked, do you think people would ever get tax deduction or credits for having pets since we spend so much money on them?
There is a way to do that. It only
Oh,
works for it
wow.
only works for dogs though. So through various times throughout history, there had been proposals in Congress to count pets as dependents. That never got anywhere. So the strategy though is that you can actually get a dog, and it's only dogs, uh, designated as an emotional support animal. And in those
Oh,
cases, then you can take a portion of their support, feed and training and whatever, um, as a medical expense. So whether that's useful or not depends on your particular situation. But yeah, it can be done.
so just dogs, not cats.
Just dogs. Yeah, cats are
Oh,
not allowed
wow.
to be emotional support animals.
They just worry about their own self.
Yeah, pretty much. And I've had cats. I've never had a dog personally. So I mean, cats love me. So I guess
I'm
I
a
will
cat
not.
person. That's why I asked that.
Okay.
Ah, they're not supportive on any kind of emotions.
No, no. And if you talk to like police officers and stuff, cats will eat you, your dog won't. So there is something to be said for that.
Oh, wow, that's sad. Okay, I have a question about W-4s.
Uh,
Someone wants to know, should I adjust my W-4 to have more or less tax taken out of my paycheck, and how is that figure coming about? How do you figure that out?
well, the simple way is look at last year's tax return. If you're assuming you have the same job, did you get a refund? Did you owe? If you owed, you can have more tax taken out on your W-4. And if you got a refund, you might want to consider taking less out. So the W-4 is the form that you fill out when you have a W-2 employment, just a regular employee kind of relationship. And what it does is it tells the payroll department how much to withhold on your paycheck. Now, the W-4 and the payroll system just has loads of problems, and in 2020 they changed the form to try to fix one of these problems, but it doesn't work. So um, the issue is with either people who have multiple jobs or there's a married couple and there's multiple jobs within the household. And so when your payroll company or payroll processor sees your paycheck, they only see that. And so they don't know what other jobs are in the household. So on the modern W-4, there is a tax table that says, okay, well, if my total household income is this, then withhold at that rate. But people don't fill it out right, and I've seen lots of payroll processors, still screw it up as far as withholding the right amounts. So you got to be really diligent about that, and it's especially true if you have very disparate income. So one spouse makes a lot, the other spouse makes a little. Then the one that makes a little is not withholding nearly enough, and that can drag the whole thing down. So, um, so that's what the W-4 attempts to do. Um, so if you withhold too little, then if it's extreme, the IRS can actually come in and force withholding, and force backup withholding, and force the payroll companies or the payroll processor to withhold at the maximum rate, which would be like single, no dependent kind of thing, for everybody in your tax household. So that's a possibility. On the flip side of things, if you're getting massive refunds every year, all that means is that you gave the government money you didn't have to, and they're returning it to you, right? So, it's not a great use of your cash flow. So ideally, when it comes to filing your taxes, you'd be dead even. No, nothing owed, no refund, every single year. Now, obviously, there's fluctuations, and I made a little more this year, I made a little less this year, whatever. So it's never going to be perfect, but that's the goal, is to be right on target. And so the other problem with the W-4 that nothing has fixed is the pay period annualization. What that means is that if you every time you get a paycheck, they look at that pay period and they say, okay, you get paid twice or every 2 weeks. So you're gonna have 26 pay cycles per year. So we're gonna take this one pay period, multiply by 26, and then figure out whatever we should have withheld based on that. So if you make the same every pay period, then that's fine. But if you have any kind of variability, like either your hours go up or down, or you get a bonus or anything like that, the periods where you get high income get withheld way too much, and the periods with low income get withheld way too little. And so maybe it averages out, maybe it doesn't. It just depends, right? So you have to be aware of that. And so, like I've seen cases where some companies will allow the employees to fiddle with their withholding settings just automatically. So I knew a bunch of people who used to work for American Express that did this. Apparently, in their system, you could just select on their internal system, and it would just process through no problem. And so there would be people who would say, "Okay, well, I'm getting a big bonus this quarter or this paycheck, so I'm gonna mark myself as exempt for this paycheck, and I know I'll catch up on the rest of the paychecks and everything." And so they do that, and then they forgot to turn it back afterwards. Forgot, right? So it's like, um, so and then they end up at the end of the year with no withholding whatsoever or very little. And they're like, "Oh, what happened? I don't know." And it's like, "Oh, well, now you owe a ton of money." Um, so, you do want to manage it. You don't want to overmanage it. So, if you have variable income. So just something to be aware of. And, ideally, you want to check up throughout the year and make sure that everything is running along smoothly so that if you're in April and quarter one is done, then you can project out, whatever I've earned this year so far times four, am I in line with the tax rates? And then after quarter two, you can look at it and say, okay, 6 months times two, am I in line? And so you can do those adjustments throughout the year. If you have, income that's variable like that. If you're just straight salary or you always have the same amount of hours, then you probably don't need to worry about it. But that's the W-4 stuff.
Alrighty, looks like we have a 1099-K question.
Oh.
So someone wants to know, have there been any updates to the 1099-K reporting rules for 2024, 2025, and beyond?
So yes.
Yes, I was gonna say, yeah, not a lot of people like them.
Yeah. So I think the latest one was they changed the amount.
Yep, they did.
2024. So I'm just doing a
And then in 2026 too, it's gonna be like 600. It will decrease
Yeah.
from 600.
So the original law change was back in what was it, CARES Act, I think,
Mm.
2022 or 2021. So the original law change. Well, okay, let's talk about what 1099-K is. I just want to define terms. So 1099-K is a payment processor report. So if somebody earns or somebody brings in money through PayPal, through American Express, through third-party data processors, through Venmo, through Airbnb, these are all payment platforms, right? So what the 1099-K is, the processor is saying, hey, this taxpayer with tax ID number, whatever, received payment through our platform of X dollars in the year. And under the old rules, in order for the platform to create one of these reports and it gets filed with the IRS and you get a set of copy, just like every other 1099, um, the old rules were that you had to have at least 200 transactions during the year, and the total dollar amount of those transactions had to be over $20,000. So if you were selling something for $1 and you sold 15,000 of them, you still wouldn't get a form because you didn't meet both thresholds, right? So come along 2021 or whatever it was, and they changed that and they said, okay, now the number of transactions doesn't matter at all. All we're going to do is if your total dollar transactions is $600 or more, then the processor has to create a 1099-K. And so this was supposed to go into effect in 2022. And right at the end of the year, the IRS said, okay, we're gonna push it back another year because we can't get this done. And then 2023, same thing. 2024, now we are in the reporting period for 2024, and they are saying that instead of $600, we're going to do it for $5,000. Okay, and then if you exceed $5,000 in one of these platforms, they will send you a 1099-K, and the crux of this whole thing is that there is a lot of non-taxable activity that happens between people, like, reimbursing for going out to dinner, or you know, my kid's Girl Scout thing, has to be paid. So there's a lot of people that would get caught at the $600 level that don't have any tax reporting requirement whatsoever on this information. But if there's a 1099K out there, now you have to reflect that in tax return somewhere and say, hey, this is an adjustment to income. It's a Schedule 1 issue, and this is actually not taxable, and it's a whole thing. So at the $600 level, they were estimating that there were going to be 30 million of these 1099Ks out there. And now, with $5,000 threshold, there'll be obviously less than 30 million, but they're going to step it down to that $600 threshold in 2026. So we'll see if that actually happens or not. But that's the current thing. So if you have PayPal or Venmo or whatever, and you received at least $5,000, expect one of these 1099s to come in the mail or in your online portal or whatever, with those payment processors, and that then you have to match it up. So at 5,000, it's more likely that it's business revenue, right? That you're renting out your place on Airbnb, or like I pay my lawn guy on Venmo, so Venmo should be issuing him a 1099K. So at 5K, I think that's a reasonable base assumption. There still might be some cases where it's just reimbursements, but then you have to make that argument on your tax return. At 600, though, it's like there's going to be giant amounts of people that have to do this adjustment on their tax return, so that there's not a matching issue. Because what happens when you file any tax return is that it gets sent to the IRS, and then in a couple months, usually around August, they will do a matching procedure where it's like, okay, we've got all this information from taxpayer Joe from third-party sources. We've got a tax return from taxpayer Joe. Are all the third-party sources reflected in the tax return? If no, you're getting a letter, right? It's one of these CP 2000 letters. And it's just an automatic letter that goes out, and it says, hey, you forgot to include this. Based on our calculations, you owe us money, right? And sometimes those letters are right, sometimes they're wrong. It just depends. And yeah, so if that $600 threshold gets implemented, expect a lot of that. But for right now, 5K is the threshold.
So you do feel like the 1099K change was necessary?
No, it wasn't necessary at all. They just wanted to capture. They just wanted to capture more people who they think are skirting underneath the limits. So they lowered the limits. Now, how much will that capture? Probably not much.
Right.
But is what it is.
Understand. So it looks like we have a student loan question. Someone wants to know, how does student loan forgiveness affect their taxes?
That is actually a great question. So normally, any kind of debt forgiveness is considered income. So like if you get a credit card that you didn't pay and they write it off, you get a 1099-C, which is cancellation of debt. And that, because when you borrowed the money, you didn't pay taxes. When you failed to pay it back, that all becomes taxable income in that year that you failed to pay it back. So it doesn't go back to when you borrowed it, it stays current. So, but for student loans, typically the way it has been structured so far is that when you're in one of these programs, like if you work for a nonprofit or a government agency for 10 years, then they forgive the balance, that kind of thing. So the way those have been structured is that it does not have a tax impact. And because you cannot bankrupt student loan debt, and it just stays forever if you don't pay it, then there's no cancellation issue because it never gets canceled. So far that's been handled, reasonably. Hopefully that will remain as it is.
Hopefully.
Yeah. But you never know.
Yeah, you never know. It looks like we have a canceled debt question.
Okay.
Someone wants to know, how does that affect their taxes when
Well,
it comes
it's
to
income.
cancellation of debt? Right, it's income.
So, it depends on the type of income. So, let's say you have a Let's say you have a mortgage that you didn't pay. Well, if it's a personal loan, like for your personal private for your personal residence, then there's no offsetting thing. Um, so like in the wake of the financial crash of '08, this was a huge problem where people were getting foreclosed on mortgages, they were getting this canceled debt income. And so they had to pass a special provision, which was basically a forgiveness. It was Form 982, if I remember right. And basically, you could say, okay, yes, I have this cancellation of debt, but also I lost my house, and that balanced out, right? And so there ended up being no net tax impact. Although I saw a lot of people who didn't do that correctly ended up paying taxes that they shouldn't have owed. Too late now at this point. If you have if it's an investment property and you got foreclosed on and there's cancellation of debt, well, then there's a business loss, right? And so, there's issues there with whether it's ordinary or capital, and it depends on the fact and circumstances. We actually had a client have to go through that many years ago, where we had to make the case that it's an ordinary loss that counteracts the ordinary income of the canceled debt rather than a capital loss. It's a whole thing. Um, and then if it's just like credit card debt, for example, then it's just income you have to pick up because there's no, you got the thing whenever you bought with the credit card, so there's no offsetting loss, and then it's just pure income. There's another issue that a lot of times these banks take years to write off this stuff. So
That's true.
it might be that you didn't pay a credit card 3 years ago, and only this year you're getting a 1099-C for it. And so, even if there was a corresponding loss, maybe it was back then and the carry forwards were such that you already used up the loss and now you have to pick up the income. So yeah, it gets hairy pretty quickly. So ideally, obviously don't take out debt that you can't pay. But stuff happens. I get that.
Things happen.
Um, but yeah, it can be very unpleasant from a tax perspective. But again, all depends on the circumstances, what happened when, and what kind of thing happened. So that all goes into whether it becomes a real problem tax wise or not.
Right. And if it can get waived, right? Sometimes you can waive it for the
Yeah, I mean, de
cancellation.
I mean, depends on the issuer. Sometimes
Right.
sometimes as part of the settlement, they'll say, "Hey, you're
Mhm.
not going to report this. You're not going to write this off as a cancellation of debt," and sometimes they will. So just kind of depends.
Right. Definitely, it depends question, guys.
Very much it depends question.
So we have another question. Client wants to know if I inherit a house, do
Mhm.
I have to pay taxes when I sell it?
Maybe.
So it depends.
It depends. So when you inherit property, your cost basis is whatever the value is on that day you inherit. So if grandma bought a house for $5,000 back in 1952 and you inherited here in 2025 and it's worth $500,000, when you go to sell it, your cost is $500,000, regardless of what grandma paid, regardless of anything. It's whatever the value is when you received it. So you have to look at, okay, well, I inherit on this date, I sell on that date. Is it short term, is it long term? If I lived in it, do I get a personal use exclusion? If I lived in it for up to 2 years out of the last five, am I married? Am I single? And then, do I have a taxable gain? After all that is considered. So maybe. If a lot of people who inherit property, there's kind of like two camps. So camp number one is they sell it right away. And if you sell it right away, then there's no gain because there hasn't been any time for the market to do anything. And there's no tax there. The other camp is people who inherit the property, they live in it and just stay there forever. So you don't see too many cases where somebody inherits and then they sell it like 3 years later. So that would be uh, probably the situation where there would be the most tax, because maybe you don't build up your 2 years of personal use exclusion, maybe you're single or what have you. So there's a large amount of it depends there, but yeah, it's kind of the basic building blocks. The key point is when you inherit property, your cost basis is the value when you inherit. And that's what's called the step up in basis. And that applies to stock, it applies to real estate, it applies to any kind of asset. Um, And under the current administration, I'm not concerned. But under the last administration, they were actively looking at that as to whether to eliminate that provision. But obviously that never happened, so that's good.
All righty, so we have another question. Someone wants to know if they can write off their moving expenses.
Their moving expenses. So,
Ah,
couple things. In the old days, yes, as long as you moved more than 50 miles and it was for work
mhm.
purposes, then you had Form 3903 and you could deduct moving expenses. Under Tax Cut and Jobs Act, which is 2017, then those got disallowed except for like armed forces. So if you were a military person and you moved and you had moving expenses, a lot of times the military would pay for you to move. But if you had out-of-pocket moving expenses, you could deduct those. Um, there are some states that still allow for moving expenses, but not federally. So like California is one of those. And then um, and then there's corporate moving expenses, which is a different kettle of fish, where you have professional like relocation companies that that move their employees, and that is a business expense if it's for business purposes. So most of the time, no. Sometimes, yes.
Understood. That was really quick,
Yeah.
that question.
Sometimes.
Right, sometimes. So it looks like we have a HSA question.
Okay.
Someone wants to know what tax benefits are there for a health saving account?
Yeah.
Um,
So
what's the benefit?
if you have an HSA, then you can contribute. I think this year 7,500 for a family, and or it might be 4,000 and 8,000 this year. I don't know. It changes slightly every year. I'd have to look up the exact numbers, but roughly 4,000, 8,000 for 4,000 for a single coverage, 8,000 for family. So if you contribute to that, that is a tax deduction. That is goes on your Schedule 1 adjustments to income, and that reduces your taxable income. Great. Once the money's in there, then if you take the money out and you use it for medical purposes, it's tax free. So you get a break when you put it in, and then you don't have to pay tax when you take it out if you use it for medical. If you put money in year after year after year, and then in retirement, you still have a balance there, and you take it out for non-medical expenses, it basically acts like an IRA, and it'll become just regular, ordinary income when you take it out in retirement for just general spending. But even in retirement, if you use it for medical expenses, it's still not a taxable event. So it's a nice little side benefit. You need to have a high deductible health plan in order for that to work. So your deductible needs to be like 6,000, 12,000, 13,000, something like that. Um, and that's where those the deposit limits are always going to be less than the deductible limits for that corresponding thing. So like if you have a family health insurance plan that's high deductible, it's going to be 13,000, I think is the current number. And so, but you can only contribute not 8,000 to an HSA. So, there's still going to be a gap there. But hopefully you don't need to use it every year, right? And you can let it build up for however long in order until you do need it, and then you can take out that 13 or whatever tax-free for medical purposes. So on your tax return, there's two different forms. So the HSA company will give you two different forms. One is the 5498, that's the money going into the HSA, and then there's a 1099 SA, which is the money coming out of the HSA. And you just report those on Form 8889 on your tax return, and you're telling the government, hey, this money came out of my HSA and I used it for tax purposes, therefore don't charge me anything. And that's usually fine. I've actually never seen that questioned. So yeah, it's a nice to have, but it doesn't move the needle in a huge way, because even if you're in a high tax bracket, 35%, let's say, and you contribute 8,000, well, we're talking about 35% of 8,000, so $2,600, $2,700, something like that worth of tax savings. So might as well, but it's not gonna, dramatically change things.
Alrighty. So we have a military question.
Oh,
So what tax benefits are available for military members?
A couple. So if you are in combat zones, you might get code Q on your W-2, which is non-taxable combat pay. There are benefits as far as there's special retirement programs for military, sort of like your TSP. There are the moving expense coverages, things like that. If you're in the reserves, your reserve expenses as far as uniforms and travel, if you have to go one weekend per month, to your reserve unit, you can still deduct those as expenses. That goes on 2106, which was eliminated for everybody else except for reservist, essentially. Um, and so yeah, there's a lot of little things. The big one is the non-taxable combat pay, if that applies to you, because that could be significant. But the others are just kind of like nibbling around the edges kind of stuff. A couple thousand here, a couple thousand there, as far as deductions. Uh,
Is
yeah,
there like a special like a filing extension rule too for them as well?
there can be. Yeah, if you're at an AFO or APO. Now remember forgetting the thing. Yeah, basically if you're overseas, you have a filing extension typically.
2 months, right? I think it's like 2 months.
Yeah, it's the June. I think it's June 30th, so it's like 2.5 months.
Cool.
A lot of times we'll see people in the military, they'll have people like off the base do your taxes for you, and it's like just because you just have the one thing because you're overseas doing whatever. It can get more complicated. So what happens sometimes with people who've been in the military a while is that they'll move around to different bases. And if they're financially minded, a lot of times they'll buy a house in each location and they end up with like 6 different rental properties in all these different places. And military towns are great for rentals because there's always an influx of people that need housing. So like where I am here in Atlanta, like about 2 hours down the road is Columbus, Georgia. It's a big military base there, very strong rental market. So it's not a bad plan, but this is not financial advice.
I think we have a client. We just recently scored a client that is doing exactly what you said.
Yeah.
As he go wherever he stays at, he buys a home and rents it out.
Yep. Yep.
Smart move.
Yep. It works.
So it looks like we have a lottery question.
Ooh.
So someone wants to know, how does winning money from a casino or lottery affect my taxes?
Yeah, so it's income. It's just ordinary income, and gambling is a little bit odd. So you have depending on how you win it, you might get a form, you might not. Um, there's a W-2G, which is gambling winnings. So like if you win an actual lotto, like a state lotto, you'll get a W-2G. If you win a slot machine, you'll get a W-2G. If you win a table game like poker, you might not. Um, and it's kind of irrelevant as to why, but it's just a weird thing, right? But you are required to report everything regardless of whether you have a form or not. So you report gambling earnings, gambling winnings, I actually say, on Schedule 1. And then if you have losses, and everybody does, because nobody wins 100% of the time, except for one guy, I did see one. I'll tell you about that in a second. So if you have losses, then those go on your itemized deductions, Schedule A. So first rule, you're only allowed to deduct up to the amount that you win. So if you win $10,000 and you spent $13,000, then you can only deduct the $10,000 on your itemized deductions. So the extra three is just that's what you spent. There's no tax benefit to that extra three. And you can kind of imagine like the rationale behind this is like, well, we don't want to incentivize people to spend all their money gambling, so let's just limit it to the amount of winnings, right? So that's thing number one. Thing number two is that since the Tax Cut and Jobs Act, with that doubled the standard deduction. So like this year for 2025, the standard deduction for single is $15,000. For a married filing joint is $30,000. And so if you don't meet that standard deduction, if your itemized deductions don't exceed the standard deduction, is a better way to say it, then whatever your itemized deductions are just money that you spent. You get no special tax benefit from it. So let's say you win $10,000 and you have $13,000 worth of losses, but your itemized total is not enough to exceed the standard deduction. That $13,000 that you spent just kind of evaporates. There's no tax benefit to it whatsoever. And the $10,000 just becomes income, right? So now you're paying tax on income that you didn't actually get because it's gambling and that's just how it is. Um, so, you got to be mindful of that. Now, the one guy who didn't have any losses, and I'm hoping this is still true, I haven't talked to him in a number of years. There was a guy who comes in and he's got, all of his papers, and I'm, doing the tax return. He's got his W-2 and he's got a mortgage and, whatever else. And then I'm halfway through his stack of papers and there's a W-2G, and they're long, so they're not like a full sheet. Um, and it's like 1/3 of a sheet. And so it says, winnings in box 1, 1, 0, 0, 0, 0, 0, 0. And I looked at it and I was like, am I seeing what I think I'm seeing? And yeah, sure enough, he won $1 million. And and it was one of those times the Powerball got to like some ridiculous amount. And if you get every number except the Powerball, it's a flat prize of $1 million. And that's what he got. That was the first time that he played the lottery. He bought 2 tickets and he won on one of them. So I guess he spent $4 to win $1 million. And he did not gamble after that. So that is the one case that it worked out, and he didn't have any losses, and he was smart about it, and he bought a house, cash, and then he put the rest into like Wells Fargo advisor, and kept his day job and everything. So it's just the like if you talk to like the financial advisor types, like he did exactly what you should do when you win lottery, but nobody does except for this one guy. So. Uh, if you do win a big prize, as a by the way, a lot of times they will withhold 20% as just like off the top. 20% is not enough. So so be aware that your tax rate is actually going to be higher. People say, "Oh yeah, they took the taxes out. I'm fine." It's like, no, you're not. They took taxes. They took some taxes out. They did
But
not
not
take out
everything.
enough. Yeah.
Right. Yeah.
So you have to like like before you cash the ticket, talk to an accountant, talk to a lawyer, right?
Yep.
Those two should be your first calls, and they'll keep you as safe as possible.
Yeah, because they'll spend the money and then they have to pay all that money back. Well,
Yeah,
not all of it, most
yeah,
of it.
that could be a problem.
Yeah. So it's 5:52. Do we have some
I
time
don't
for
know. Do
one
we
more
have a
question?
quick one? Some of them might be quick today.
So we have a question on stock gains.
Okay.
Someone wants to know, how do I avoid paying taxes on stock gains?
You don't have gains.
I was gonna say that
So
too, but
so well, no, there's a couple of different things. So one is that if it's long term, there is an income threshold at which you have 0% long term capital gains tax. So it's like $60,000 taxable income, which means your actual gross income is like $80,000 or $90,000. So if you're under that threshold, you could have 0% long term capital gains rate. So that's thing number one. Thing number two is tax loss harvesting. So if you have gains and you have losers that you haven't sold, you can sell the losers, realize those losses, and those can counteract your gains. And like we have a partner that we've hooked up with, FREC, FREC. They have elevated that strategy to an art form, as if you want to do direct index investing, which is pretty cool, to be honest. And they can build up your losses over time, algorithmically, which is amazing. So those are kind of the two basic ways. Otherwise, if you sell something and you have a gain, and a gain on a net basis, meaning that you take all your winners, all your losers, and you come out with a positive number, and your income is such that you are in one of the taxable ranges for income, then you're just going to pay taxes. So maybe you have offsetting other things, offsetting losses from something else. Maybe you have maybe you bought the Tesla this year and you have $7,500 worth of tax credit. So there could be other mitigating factors, but purely on the stock basis alone, those two elements. So are your income threshold for 0% capital gains tax and offsetting losses with tax loss harvesting. So those are the two basic arrangements.
okay. So it's almost 5:55. Well,
All
my
right.
time.
All right. Yeah. So we'll cut it off there, and we will talk about what to do next. So let's do that. So what happens next? Next steps is you should become an explorer. And we talked about the starter course earlier. The starter course is that intro to DIY tax planning. It's got 4 different modules with I don't know, there's 20 different little lessons in it, and along with some worksheets and things like that of me explaining to you how to do basic tax planning. Depends on if you have a day job or not, if you're purely self-employed or a small business. But you go to techsherp.com/explorer. It's free. You sign up there, you'll get access, and then you can get into the starter course. And there's a bunch of other things in there too. There's the partnership success blueprint. There is the quick and dirty bookkeeping module or course, whatever you want to call it. And you know, and then you can ask questions on streams like this. You can just email in, or you can put on the forum and things like that. So it's a great resource for people, and it's part of the way that, again, if we go back to the mission, is to save $1 trillion, and how we're going to do that is through technology, right? And this is one of those technologies that we can use to get people the message that they can do things in order to save money on taxes. And if we all do that together, it's actually not going to be that hard to save $1 trillion. So it doesn't have to be $1 trillion a year, by the way, just like in total, right? Because again, tax revenue last year was about 4.3 trillion. So if we took $1 trillion in 1 year, that would be almost 25%, which would be a pretty hefty hit. That'd be hilarious to watch the politicians lose their minds. But yeah, it is. That's the goal. So if you want to be part of our $1 trillion savings, join the Explorers, and we'll see you next time. All right, so we'll do it all over again next week. What is next week? Next week is the 4th, February 4th. And same time, 6 p.m. Eastern, 5 p.m. Central. And we'll answer more questions and figure out other ways where it depends. All right, that's it for now. We'll catch you guys later.
Alrighty, have a good day.